I think that's a very good question, Sudeep ji, once again. The question is how to differentiate between the sensitivity analysis and the scenario analysis. So that is what the question is.
In case of sensitivity analysis, we are considering the worst scenario and the better scenario.
Right. Okay. And the scenario analysis is?
Scenario analysis, you are telling me to consider 10 probable or 20 probable aspects.
Right. So, it's like this, Sudeepji. When you talk about the sensitivity analysis, so sensitivity analysis is with regard to a certain factor. So you have prepared your base case cash flow projections. Now you want to check what if my selling price decreases by 5%. What if my variable cost goes up by 5%?
Yes.
What if my fixed cost goes up by 5%? So this is what is your sensitivity analysis. That means how the cash flows that you have are sensitive to various factors. So how is going to be my cash flow if the rate of interest charged by my lender increases by 1%? Right? So this is how okay. And this is your sensitivity analysis. That means you're trying to find out as to how sensitive your cash flow is with regard to a particular factor or which is governing your cash flow statement. So when you talk in terms of scenario analysis is a much broader picture actually. It's much broader picture, and that means you will assume certain things as far as the ramping up of the operations is concerned, as far as the demand is concerned, as far as the competition is concerned. So taking all those macro factors, what you create is your scenario analysis, and taking into account the micro factors, what you create is your sensitivity analysis. So if I can sum it up, I would say scenario analysis takes into account the macro factors, sensitivity analysis takes into account the micro factors.
Micro factors.
Yeah, I hope that answers your question.
Thank you.